In this brief video, we are going to take a look at some introductory notions related to the field of finance, and we will conclude with some notions about the importance of finance with respect to a firm. Although there is a wide variety of functions and careers in finance, we can simplify these into three broad categories. While these categories are certainly not exhaustive, they do cover a big portion of the finance world, particularly where people have their finance-related careers. The first category or track in finance, and the subject of this introductory course in finance, is financial management. The second track in finance, and the subject of a more advanced course in finance, is financial markets and institutions. And the third track in finance, and the subject of several more advanced courses that you could take later on, is related to investments. So let's go ahead and look at each of these in turn. Financial management is primarily related to the finance function in a company, and it deals with three big decisions that financial managers in a firm face. The first decision is the investing decision, which is concerned with evaluating and selecting the projects that the firm will pursue. We will deal a fair amount with this topic in the second half of the course when we look at capital budgeting decisions. The second decision is the financing decision, which is concerned with deciding how the firm will pay for the investments it is pursuing. Where and how will the firm raise the necessary funds? We will look at debt and equity and the role these play in raising capital for firm investments later on in the course. The third decision is the dividend decision, which is concerned with determining how much money should be returned to the investors, which are the ultimate owners in the firm. And we will not be spending time on this particular subject in this course. It will show up if you continue in finance in future courses. The second track in finance is related to financial markets and institutions. These firms manage the flow of money in the financial markets and help determine where capital is allocated across the economy. This first term here, financial intermediation, is an important notion in the world of finance, and it refers to the idea that there are savers of money in the world and there are consumers of money in the world. There are people with excess capital who would like to put that capital to work, and there are people who are short of capital and who need access to these funds. Financial intermediaries are companies that are in the middle ground, bringing together savers and spenders. A very common financial intermediary is a bank. They accept deposits from individuals with extra money, and they aggregate that money and then lend it to parties that need capital. There are also firms that aggregate money and then buy equity positions in companies. This particular course will only deal with a few of the ideas related to the financial markets. A final broad category in finance is related to investments. There are two broad categories of investments: equity investments, where you buy stock in a company, and fixed income investments, where you buy bonds from a company. We will look at both stocks and bonds later on in the course. Okay, let's circle back to the primary focus of this course, financial management. We will start by noting that financial managers focus on the primary goal of the firm, which is to maximize the wealth of the firm's owners. For a publicly traded corporation, this means that managers should make decisions that will maximize the value of the company, and that will be measured in maximizing the stock price over the long term. In maximizing value, there are three things that affect or drive value. The first is generating cash flow. Managers should go about activities that increase the cash flow of the firm. When we talked earlier about the investing decision, this is the primary goal of making good investment decisions, to increase the cash flow of the firm. The second driver of value is the timing of those cash flows. Everything else being equal, cash flows received sooner are worth more than those received later. We will spend a fair amount of time in the course looking at the notion of the time value of money and how that relates to financial management. The third driver of value is the risk associated with the cash flows. The higher the risk associated with the cash flows, the less valuable those cash flows are. The reason these cash flows are less valuable is because they are less certain. You would not be willing to pay much for future cash flow if there was a high likelihood that it would never materialize. Like the other topics, we will spend a fair amount of time looking into the notion of risk, and we'll look at various ways that is measured and analyzed for a firm. I've mentioned the notion of the firm several times in preceding slides. In this slide, we'll look at a few possible types of firms, and we'll zero in on the type of firm we have in mind for this course. The first type of firm is the proprietorship. This is a very simple kind of firm to set up, which is the attractive aspect of proprietorships. The big downside is that these firms have unlimited liability. Another drawback is that the access to capital is limited. It's largely limited to the capital that the sole proprietor brings to the table. A second category of firms is partnerships. Here we'll just look at a couple of kinds of partnerships. The first is what I've termed as a plain partnership. This is a situation where all partners have unlimited liability, and how the cash flows are split is defined by a partnership agreement between all the partners. A big downside here is that all partners are what is called jointly and severally liable for the obligations of the firm. This means that even if there are 10 partners, if there are 9 of them that declare bankruptcy, then that 10th person is on the hook for everything the firm owes. There's another kind of partnership that deals with this unlimited liability problem, and that is called a limited partnership. In this arrangement, there are 2 classes of partners. There is the general partner class and the limited partner class. The general partner is charged with the day-to-day operations of the firm, and they will likely receive a disproportionate share of the cash flows. For instance, if a general partner only invests 5% of the capital, they may be entitled to 10% of the cash flows as a way of rewarding their work on behalf of the firm. General partners have unlimited liability for the debts of the firm, so if things go bad, they are on the hook. The limited partner class comprises a more passive role. These partners supply capital but are not allowed to be involved in day-to-day decisions regarding the company. In exchange, their liability is limited to the amount of capital that they invest in the firm. This third type of firm is called the corporation. A mark of these firms is that investors have limited liability for the obligations of the firm. They can only lose what they've invested. We'll quickly look at 3 types of corporations. First, there is the C corporation. This can be either a public or private company, and most large U.S. companies are organized as these C corporations. Another benefit of this arrangement is access to capital. Large firms can raise substantial amounts of capital into the billions of dollars by selling stocks or bonds to help fund the firm's growth. There is no limit to the number of shareholders a C Corp might have, so raising capital can be done on a very large scale. A drawback to the C corporation is the potential for double taxation. This refers to the notion that the company pays taxes on profits, and if it then distributes a portion of those already taxed profits to shareholders, these shareholders then pay an additional tax on that dividend income they receive. A second type of corporation is the S Corp. This is a special kind of entity called a pass-through entity. This means that the company profits aren't taxed at the corporate level, but these profits pass through to the individual owners and they are taxed at the individual level. One drawback of this particular kind of arrangement is that there is a limit of 100 shareholders in these kinds of corporations. So they will likely face rather sizable constraints on how big they can get and on how much money they can raise. Then there is this third type of corporation that is a relatively new creation, and it is called a B corporation. These are specially organized corporations which are explicitly focused on things other than value maximization. These companies are allowed to focus on what is commonly called a triple bottom line, a focus on social good, environmental sustainability, and on profits. There are very few examples of these types of companies in the publicly traded arena. Etsy is one prominent example. Many of these firms will be privately held instead. Finally, there is a type of firm called a limited liability company that is common in a few industries as a way of organizing. These are relatively easy to form, and they have a limited liability for their members. The entities are not taxed at the LLC level. Instead, the cash flows are passed through to the members, and they are taxed at the individual level. For the purposes of our discussion through this course, we will have in our mind the C corporation, although many of the principles we will discuss have broad application to the other types of firms as well. So that is all for this introductory video on the firm. I will talk with you again soon as we look at the next exciting topic.